I'm a beginner. I'm staring at bills and headlines about banks, and I have zero knowledge. Money exists everywhere, but what is money actually? If banks can create it, and everyone treats it like it exists, what am I even holding? I'm confused. What is this thing people call money? A minter appears and says, start with a ledger. Money isn't magic. It's a social technology for tracking who owes what, a claim recorded in shared books. Think in assets and liabilities. Your money is usually someone else's liability, like a bank deposit. It exists as an accepted claim, even when it's just numbers on a ledger. I try barter, a sandwich for a haircut. It fails comically. The barber doesn't want what I have right now, even though we both know money exists as the usual solution. The minter explains the double coincidence. For barter to work, you need someone who wants what you have when you want what they have. That coincidence is rare, so trade breaks down. Barter gets worse when goods don't divide cleanly. I offer half a goat for vegetables, and chaos follows. Some things are indivisible, awkward, and hard to trade fairly. The minter says, some goods don't split, rot in storage, or are hard to move. Money is better as a medium and store because it's easier to carry, divide, and keep. Without money, barter needs endless exchange rates. The minter draws a chart, eggs to shoes to haircuts, and the complexity explodes as every good needs a price in every other good. That's why money matters as a unit of account. With a common measuring stick, prices become readable and trade scales, because the system can track value without drowning in complexity. Back in the cafe corner, the minter anchors the classic definitions. Money exists as a medium of exchange, a unit of account, and a store of value. Wojak copies each line, because getting the account function right keeps every later idea anchored to what money actually is. The minter contrasts real stuff, food, housing, skills, with money, which is a set of claims on that stuff. Those claims can be powerful, but they are not the same as real production. The classic point is that claims exist only because the real economy exists. Here's an abstract analogy. Concert tickets aren't the concert, they allocate who sits where. In the same way, money is a token system that allocates access to resources. Tickets exist as allocation tools, and money exists for allocation at scale. People accept money because of trust, enforceability, broad acceptance, taxes, and stability, plus a network effect that strengthens as more people use it. Wojak asks, so it's belief? The minter replies, belief, plus institutions, rules and enforcement that make acceptability real and keep the classic system working as long as those supports exist. Commodity money, like gold, has intrinsic use. Fiat money is a token or note that functions because the system treats it as money. Fiat is backed by rules, law, and central authority, not by the material itself. That's why these two forms differ, even though money exists in both cases. Paper started as a claim on something. You gave coins to a trusted keeper and got paper back. That paper was credit, an IOU you could pass along, like a chain that bridges metal to money that exists in records. So money is an IOU chain? Exactly. A bridge from coins to paper, where the claim can move without moving the metal, and money exists because the credit relationship exists. To demystify money, start with accounting. Before coins, people kept an account of who owed what. Alice owes Bob 3 sacks. That credit can exist without any coin at all. Standardized coins came later as a convenient token. The classic core is older, credit recorded in an account. Money exists when those obligations exist and are accepted as payable. Back at the apartment, the trick is to see the balance. Your $100 is your financial asset, but it exists as the bank's liability, two sides of one ledger entry. Nothing magical. For every asset, there's a matching liability. That's why money exists in the ledger universe. Classic accounting symmetry, not free-floating value. Let's define cash. When you hold a bill, you're holding a liability of the central bank, paper money that exists as a standardized IOU. Because it's standardized, you can pass it around without checking anyone's personal credit. Cash exists as the central bank's promise, and it works as money because everyone accepts the bill. Now define a bank deposit. That balance on your phone is not a pile of cash. It's the bank's liability to you, a promise that money exists as an entry in their system. The bank is promising to pay you cash or transfer to others on your behalf. A deposit exists as that promise, classic, Your asset, the bank's liability. They enter the bank branch expecting the classic story: deposits come in, then loans go out. The setting feels ordinary, but the idea on the wall is about to be challenged. The banker points to the poster. Deposits fund loans, end of story. Quietly, the minter notes that this is not the whole story of credit creation and how money can come to exist. The loan is reviewed and approved inside the bank. Nothing physical moves, but the decision triggers the accounting that will change the customer's deposit immediately. With the loan approval, the bank creates a deposit at the same moment it makes the loan. The shock is that money appears as a deposit entry, as if typed into existence, even though no cash pile was collected first. Freeze the moment and look at the bank's accounting. One entry is created on the asset side, a loan. A matching entry is created on the liability side, a deposit in the customer's account. No pile of cash moved across the counter. The balance changed because the bank created two linked entries, and that is how bank money can exist in a modern credit system. A natural question follows. If banks create deposits when they lend, what stops infinite money creation? The answer is that banks face real constraints, even if the mechanism looks simple. Banks must find credit-worthy borrowers and make loans that are expected to be profitable. They are constrained by capital requirements, risk limits, regulation, and the need to settle payments with other banks, all of so to avoid a common confusion, separate two concepts, capital and reserves. They are not the same, even though both appear on bank statements and in discussions about money. Capital is the absorber that protects the bank against losses, while reserves are a settlement asset used between banks. Mixing them up leads to mistaken claims about what limits lending and how bank money exists. Behind the public lobby is the backroom view of the banking system, reserves. These are reserve balances held at the central bank, and they exist as bank-to-bank money, not something regular people use day to day. When one bank owes another, it can settle by moving reserves from its reserve balance to the other bank's balance. Deposits can exist for customers, but reserves exist to connect banks in the background. Suppose you make a payment to someone at a different bank. Your deposit at your bank goes down, and the landlord's deposit at their bank goes up. The deposits are what you see, but the banks settle the transfer underneath. Reserves move between the banks, so the money exists consistently across both balance sheets and both banks' records. Clearing is the accounting step, figuring out who owes whom after many payments. Settlement is the final step, actually transferring reserves or cash so the obligation is finished. Think of clearing as the list of net amounts, and settlement as the final transfer that makes it real. This infrastructure is how modern money exists reliably between banks. Banks transform short-term deposits into longer-term loans. If everyone wants cash at once, even a healthy bank can face a liquidity need because it can't instantly turn all assets into cash. That's why central banks matter. They can provide liquidity as a backstop. When the system needs cash quickly, it helps banks meet withdrawals so money continues to exist smoothly in everyday use. Interest is the price of money over time. A basic way to see it is $100 now versus $100 later. Waiting has a cost, so interest compensates for time. Interest can compensate for time, risk, and opportunity cost. So yes, money has a time dimension, and interest is how that time value exists in everyday lending and saving. Wojak repays the loan. His deposit falls at the same time the bank's loan asset falls. Lending can create a deposit, but repayment is what destroys deposits. Bank money. That's the complete, classic cycle. Money can exist, and it only exists while the bank deposit exists. When repayment happens, the accounting reverses. Repayment destroys bank money by deleting deposits, while the bank's loan claim is reduced. Create on lending, destroy zoom out from the bank. In the real economy, goods and labor move one way, while money flows the other way. Those flows are claims, records of who can command goods. The classic point is that these claims exist because people accept them and use them to trade. Claims exist as transferable purchasing power, but the real output is the goods and services produced. Watch the flows. Money circulates as claims, while real goods move through. Prices are not just numbers. A price is a signal about scarcity and trade-offs, guiding choice and coordinating choices across millions of people. In a classic sense, these signals exist to help allocate real goods using limited resources. But when money supply and production diverge, the signals can distort. If more money chases the same output, prices change in ways that mislead choices. The signals still exist, but they become noisy. Inflation is a broad rise in prices. Wojak sees the same basket of goods cost more. One simple way to think about it: too many monetary claims chasing too few goods. If spending grows faster than real capacity, prices tend to rise across the board. The classic story is not that goods changed overnight, but that claims increased relative to what the economy can produce. The claims exist as money, but real goods are limited by capacity. Where new money goes first matters. When a banker extends credit, the borrower gets early access and can bid up certain asset prices before everyone else's incomes adjust. This distributional effect is why timing and access matter. The classic point is that money can exist as new claims entering specific hands first, not evenly everywhere at once. So who receives it? Banker to borrower, shapes relative prices, and purchasing power. Inflation can exist in different places. Consumer inflation shows up in everyday prices like groceries. Asset inflation shows up in assets like houses and stocks, even when consumer prices lag. New credit can build buying power for assets, pushing asset prices higher even without classic consumer inflation. Differentiate where the money goes: into goods today or into assets. Both can exist, and this nuance is a enter the central bank. In this auditorium, the policy rate lever is the big dial. By setting a rate target, a central bank influences the price of reserves and the rates banks face. When the central bank moves the policy rate, it shapes short-term funding conditions and nudges broader rates across the system. This classic mechanism can exist even in modern markets. The link between banks, money, and open market operations are simple. The central bank buys government bonds, and the seller receives reserves. It's a swap, bonds for reserves, inside the banking system, not a magic pile of cash. As reserves rise, liquidity conditions change, and short-term rates can move. That's why this classic tool exists. By swapping bonds for reserves, the central bank can steer money market conditions even when the public. A common misconception is that QE is just printing money. Correct view: QE is an asset swap at scale. Central bank buys bonds, and reserves increase. That's different from dropping cash into everyone's pocket. QE changes the composition of assets: more reserves, fewer bonds in private hands. It can affect prices and rates, but it's not the same as cash transfers. That distinction exists in the plumbing of money. Classic ideas policy works through transmission channels. A rate change can affect mortgage rates, business loan costs, exchange rates, asset prices, and expectations. This is how central bank policy rates move from markets into daily. So when rates rise, borrowing tends to slow and spending cools. When rates fall, borrowing can pick up. That's how money conditions transmit. These classic channels exist even as products change, because incentives still in a crisis. Crisis in the classic sense. Fear can trigger bank runs even at solvent banks. People line up demanding money, and a banker can't instantly meet every withdrawal with cash. The central bank can lend liquidity against collateral to solvent banks. That backstop helps the bank exist through the panic. The banker steadies, and the crowd calms. Taxes are a key link between the state and money. When a tax bill comes due, you must obtain the state's currency to settle it. That obligation creates a baseline demand for the currency. The need to pay taxes is a classic drive of why the currency can exist and continues to be accepted. Government spending is operationally an injection of money into the economy, payments flowing to households and contractors. Think of it as arrows that move purchasing power outward. Taxes withdraw money back from the economy. The sequence matters. Spending can occur first, and taxes follow as a drain. One reason modern systems can exist in a classic, stable flow. A common conceptual error is to compares the government's deficit to a household budget. Households are users of the currency. They can run out of money. A sovereign issuer is different from a user. The binding constraints are inflation and real resources, not running out of money. So the deficit story is not classic household budgeting. Bonds exist for a function in the system. They help manage interest rates and provide safe assets. Issuing bonds changes the mix of money and interest-bearing claims held by the private sector. So in practice, bonds can look like a safe savings account for big institutions, an asset swap, not a way for a currency issuer to get money. That's the classic reason bonds exist. From up here you can see it, a classic diagram of the money flow. Households, firms, banks, government, the central bank, and the rest of the world all connect. This is the system, and it exists whether we notice it or money moves like a river through the city. Paychecks, spending, taxes, loans, and payments. When you track the flow, the parts stop feeling random. The whole network exists as one connected diagram, not separate stories. Zoom in on the household. You earn income, you spend on consumption, and the payments leave your account as money flows to firms. In this classic diagram, your routines exist as clear arrows, not vague feelings. When you save, funds flow to banks. When you borrow, banks create purchasing power that flows back to the household. The same diagram explains both thrift and debt. These links exist in every modern economy, even when it now the firms. Revenue lands as deposits, then costs flow out. Payroll, materials, rent. The firm sits where money meets production, and this classic structure exists in every price tag and paycheck you see. For investment, firms often borrow, turning credit into new machines, software, and buildings. Profits can be retained or distributed, but the key is how firms connect financial flows to real capacity. That connection banks are the gatekeepers of credit. They underwrite, run payments, and perform maturity transformation, turning short-term funding into longer-term lending. Their choices decide which projects get purchasing power because banks create and allocate credit. Risk is never just private, it can spread through the whole system. When banks misjudge, the flow of money tightens for firms and households. This classic dynamic exists even when add one more piece. The rest of world node appears. Trade links the city to foreign producers and buyers. Deficits and surpluses move financial claims across borders as money and goods travel in opposite directions. Exchange rates adjust to balance demand for currencies, and those moves transmit inflation or disinflation through import prices. It's still the same classic flow story, just extended beyond the city. The mechanism exists back at the apartment. The classic myth shows up again, that a bank takes deposits and then loans them out like a simple stash of money. He corrects it in plain terms. Loans create deposits. Deposits don't mechanically fund loans. The bank expands balance sheets first, then the deposits exist as the bookkeeping result. The common claim is that money creation automatically means inflation. But if there's idle capacity, extra spending can raise output first instead of prices. When constraints bind, labor, energy, supply chains, spending hits a ceiling and inflation rises. So inflation depends on real constraints and demand, not just more money exists. Another classic misconception is that modern money is backed by gold, as if a vault makes every unit of money redeemable. He crosses it out and writes the correct idea. Money exists because taxes create baseline demand, legal tender laws settle obligations, institutions enforce contracts, and a productive economy gives it use. To make it practical, the Minter offers a simple dashboard. First, credit growth. Second, inflation versus capacity, how close the economy is to its real limits. Third, policy rates and real rates. Fourth, the fiscal stance. Fifth, asset bubbles, where money and credit inflate prices of houses, stocks, or anything treated like a sure thing. Then it turns personal. The applicability is clear. Keep an emergency fund, understand debt types, and respect how rate changes can reshape monthly costs and risk. He adds the bigger shift. Build durable job skills, real wealth, and avoid get-rich-quick delusions. The system can be understood, and that understanding changes your choices with money that already exists. Graduation day. I'm calmer, standing straighter, because the complete money river finally makes sense. The ledger identity is right there in classic lines. Everything exists as entries, balanced and visible. Now you can read the news without fear. You finally get the system. Money exists as flows, and identity exists as a ledger that always has to balance. That's the emotional deliver. Understanding replaces fear.